Hello, everyone. Welcome to presentation given by us, APM Capital, and the CME Group. My name is Mark. I am Head of Risk here at APM Capital. For those of you that don't know us, we're a multi-asset regulated broker in Abu Dhabi. We connect our clients to global derivatives markets, including the CME, where we do a lot of business, and our clients are very happy with the executions that they get through us and with the CME. We're pleased to have Erik Norland with us, who's about to give a presentation on the economic update and outlook. This is second series of webinars we've done with the CME, and this is going to be one of three webinars. There'll be one fortnightly on different topics, and then an in-person webinar at the end, in-person seminar at the end, where Erik's kindly agreed to come and join us out in Dubai. Erik himself, we're very pleased to have him as a speaker. Erik is the Executive Director and Senior Economist at CME Group, who's responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting their impact upon those who trade in its various markets. He's also one of the CME Group spokespeople on global economic, financial, and geopolitical conditions. Prior to joining the CME Group, Erik gained more than 15 years of experience in the financial services industry, working for investment banks and hedge funds, both in the United States and in France. Just before I hand you over to Erik, just like to say that we've got a Q&A section. Please, if anything pops into your mind and you want Erik to expand on or hasn't touched upon, please feel free to put that into the Q&A section, and we'll attend to those at the end. The presentation itself should be around 45 to 50 minutes. We can have some Q&A at the end, and then we'd like to invite our SEO just for a few closing words, Nick, at the end there. So thanks again for joining us. I look very much looking forward to this presentation, and over to you, Erik.
Well, thank you so much for inviting me and for having me. It's a tremendous pleasure to be here. And let's get started. So I'm going to take out the headphones from my ears, because otherwise I hear my own voice echoing back to me. But in any case, the world has been through an absolutely tremendous change over the last few years. We have seen a huge rise in inflation, a tremendous rise in interest rates. And this is having, I think, a big effect on what we should expect from markets going forward, in terms of volatility, in terms of asset class correlations, etc. So let's get started. First, we have to show both the short version as well as the longer and more detailed version of CME Group's disclaimers, which essentially say that we cannot offer any trading or financial advice. So no advice is given or intended. But the single biggest change I think that we've been faced with is that we have come out of a quarter-long century period of very low inflation in the United States and Western Europe, in Japan, and many other places like Australia, New Zealand, Canada, etc. So kind of from the early 1990s up until 2021, inflation in the US was typically around 2%. Inflation in Europe had been around 2% before the global financial crisis, and then was more typically around 1% after the global financial crisis. And then inflation in Japan sort of oscillated in and out of positive and negative territory. And all of this gave rise to a certain correlation structure in the market that has begun to change as a result of this sudden surge in inflation to much higher levels. So one of the themes we'll talk about is correlations between asset classes and how they're changing over time. The result of the upturn in inflation has been that we've come out of the zero rate period. In the United States, from the end of 2008 all the way up until the beginning of 2022, we had rates generally speaking at zero. There was a brief period where the Fed raised rates from 2015 to 2018. They got as high as 2.375% before they were put back at zero. And many other central banks like the ECB, et cetera, the SNB, the Bank of Japan, the Riksbank, either had interest rates near zero or in some cases even below zero, at least for the deposit rates, not so much for the lending rates. And this sort of gave rise to a certain psychology in the markets where the hurdle for doing any kind of investment was zero. So if you were looking at investing in a stock, you were comparing the potential returns on that equity to zero rates as the alternative. If you were looking at buying a house or investing in commercial real estate or farmland, your choice was essentially to view the return on that versus zero, which would be your return on short-term interest rates, or just above zero if you were investing in longer-term bonds. Now, suddenly the hurdle rates have gotten much higher. Now, if you're investing in anything in the United States, your hurdle rate is now 5.375%. So if you're going to buy the stock of any corporation or the S&P 500 more generally, and you're going to go long, you're implicitly saying to yourself or to your investors that you expect that investment will do better than 5.3%, which is the risk-free rate, what you could get just by parking your money in T-bills. And the same thing is true around the world. The hurdle rates vary from one country to another. Here in France, where I happen to be at the moment, the European Central Bank has its lending rate at 4.5%, so it's a little bit lower than the Fed, but it's not too much different. And so this is changing a lot of investor calculations. It's also a big change for the hedge fund industry itself. I worked for hedge funds, as they mentioned, for a long time. And what a hedge fund does is it takes the investor capital and it puts it in risk-free rates. It puts it in T-bills or short-term papers that get roughly LIBOR, or now that LIBOR is gone, SOFR-like returns. And then it uses that as collateral to take long and short positions in the markets, whether that's equity long short or long short positions in futures markets. So when interest rates hit zero, that was really bad for CTA trend followers. It was really bad for equity long short. It was really bad for global macro because essentially the capital itself that was being invested was earning essentially no return. And so the result was that we had 10 years or 15 years of rather difficult returns for those assets. But now two things have happened. So first, the underlying capital on those investments has risen. So now you're getting 5% return on your global macro or CTA investment. And if they make a trading profit of, say, 5%, you're now up 10%. If they have a trading loss of 5%, you're at zero. So all of a sudden, these strategies which underperformed during the 2010s have become much, much more interesting. But the upsurge in inflation also has big implications for all sorts of markets, including for the equity market itself. So the equity market's valuation tends to vary inversely with the level of long-term interest rates. If you look at long-term U.S. bond yields, for example, the long-term U.S. bond yield represented here by the 10-year U.S. Treasury tends to vary inversely with the level of equity prices. So when bond yields were very low, as they were in the 1950s and 1960s, the equity market back then supported high levels of valuation. That's been even more true in recent years, especially since the year 2000, as interest rates fell from around 5% eventually down to just a few percent by 2020. The equity market began to support higher and higher levels of valuation. There were a couple big exceptions during this period in which we had a recession. For example, there was a recession in 2001 that took the equity market down by 50%. There was another recession, of course, during the global financial crisis from 2007 to 2009 that took the S&P down 60%. But during the 2010s, we had this period of very, very low bond yields that was essentially created by the Federal Reserve and by other central banks. They put interest rates at zero at the short end. And in addition to that, they printed a huge amount of money to buy bonds and repress bond yields. at the longer end of the yield curve. So this was a great period for long-only investors. The only thing you had to do to make money was to buy stocks. If you bought stocks, particularly in the U.S., you did phenomenally well. The S&P went from 666 points up to 4,700. It was a gigantic return, and the S&P's return, by the way, was actually smaller, much smaller than that of the NASDAQ. So if you had the good intuition or analysis to go into tech stocks, you did even better. But now the problem is with inflation having turned higher, bond yields are also moving higher. And that's begun to destabilize the equity market. So the equity market last year had a terrible year. The S&P fell 20%, the NASDAQ fell 30%. But it hit bottom almost exactly 1 year ago today. It was in early to mid-October last year that the various equity indices hit bottom. And as they hit bottom, the equity market did begin to rally, but it was an extremely narrow rally. So in the last year, we've had this rally that basically involved 8 stocks. So it was, basically Meta, what we used to call Facebook, Google, Amazon, Apple, Microsoft, in part because of its investment in OpenAI, Tesla, Netflix, and maybe one other company. His name I'm not remembering off the top of my head, Google or Alphabet or whatever it's called now. So anyway, those are the companies that rallied. The rest of the market really didn't rebound very much. Now interest rates in the last few months have begun to creep higher again at the long end of the curve. That's begun to destabilize the equity market again, which has begun to sell off once again. Now, if you look at the equity bond correlation, not just the levels like we saw in the previous graph, the level of bond yields versus the level of market cap. But you look at the correlation, you can see that there are very different correlation regimes in the equity market. So from 1984 up until 1998, the equity market and the bond market had a positive price correlation. So what I mean by that is on days in which equity prices rose, bond prices tended to rise as well. Now, as you know, bond yields and bond prices move in opposite directions. So that would mean that when equity prices tended to rise on days when bond yields fell. But then in 1998, that suddenly changed and the equity bond correlation went negative. At least for a while in 1998. It bounced back positive briefly in 2000, but then from 2000 up until 2020, that correlation was negative. So on days in which equity prices rose, bond prices tended to fall. And days in which bond prices tended to fall, equity prices tended to rise. And then now, just very recently, that correlation has come back positive. So why has that happened? Well, the equity bond correlation is driven by fear. But it depends what markets are afraid of. When markets are primarily afraid of inflation, that correlation tends to be positive. And so the way in which it works in a period like the 1980s and early in most of the 1990s, and for that matter, the last couple of years, is that the market's primary fear is high inflation. And so when you get a strong economic number, what happens is that bond yields go up, which means that bond prices are falling, and equity prices also fall because everybody is afraid of the possibility of much, much higher interest rates. By contrast, when you have a negative correlation, it's because the main fear is that of economic downturn, economic collapse, and deflation. And that came to the fore in 1998 with the LTCM crisis, when the long-term capital management hedge fund melted down in 1998 after Russia defaulted on its debt. And that was accentuated after the tech wreck recession, and especially in the decade and a half or so after the global financial crisis. The global financial crisis created a gigantic flight to quality. So during that time, equity prices crashed and people bought bonds. So bond prices went up as bond yields collapsed as well. So they had a negative price correlation. And then for the rest of the decade, there was always what was called risk on and risk off trades. So sometimes the economy would be doing better, so equity prices would rally and bond yields would rise, which means that bond prices would fall, so you'd still have a negative correlation. And then other times you'd have this phenomenon where where there would be a risk-off environment where everybody would do another little mini flight to quality. But now we're shifting back out of that, back towards a positive correlation environment. And this has really big implications for investors. As you can see, it's very much driven by inflation. This is basically the same chart we saw before with the correlation in light blue, but now we've put in the inflation rate from core PCE, um, the core consumer expenditures deflator number that the Federal Reserve prefers as a measure of inflation. So basically what happened is in the 1970s, we had a huge amount of inflation in the US. Inflation rates went up to nearly 10% on core PCE. The actual CPI itself, inflation rose to much higher than that. It rose up to as high as 13.5 or 14% for a while. And that really haunted investors. So for the entire rest of the 1980s, the entire first 8 years of the 1990s, the market's primary fear was inflation. How was the Fed going to control inflation? So anytime we had strong economic data, the bond market would freak out and sell off. So bond prices would drop, bond yields would rise, and equity prices tended to fall. But then by 1998, inflation had come down to really low levels. By that time, core PCE had dipped as low as 1%. It was going to stay in a range of 1 to 2% for the next decade and a half, the next 23 years, actually, the next 2.5 decades almost. And so then the market began to fear deflation. Deflation is something that's haunted the markets in the past. It was something that haunted Japan during the 1990s and the 2000s. Deflation is very corrosive to the banking system. But now we've had this sudden surge of inflation back up to positive levels, and that equity bond correlation has flipped. And this is very important for long-only investors because when that correlation is positive, it means they get less diversification. So during the 1980s, for example, and the first half of the 1990s, both equity prices and bond prices rose as bond yields, generally speaking, fell during that period. So that was good for investors, but they weren't getting all that much additional diversification because equity and bond prices tended to move at the exact same time. So they weren't getting a huge amount of diversification. By contrast, after 1998, and especially after 2008, we had the dream environment for the equity, for the long-only investor. The long-only investor, the only thing they had to do was to be long bonds whose yields were falling because of all the Fed's money printing and the ECB and the Bank of Japan doing all this QE, forcing bond yields lower and lower, which meant that bond prices were going higher and higher, and also be long equities. So they had three things. They had higher bond prices, higher equity prices, and a negative correlation, which means that their risk-adjusted return was spectacular. But now that whole situation has fallen apart. Bond prices have crashed in recent years. The 30-year US Treasury, its price is down over 50% off of its highs. The S&P and the NASDAQ, despite their rally earlier this year, are still off of their highs from the end of 2021. And the correlation is now positive. So you're getting lower bond prices, lower equity prices, and a positive correlation, which means less diversification. So we've gone from the dream environment for the long-only investor to the nightmare environment for the long-only investor. And so how is this going to play out? Well, first, if you look at the central bank in the US, its main fear, again, is inflation now. So as a result of that, they've raised rates to 5 3/8%, which is the highest, by the way, that they've been since early 2001. So we're now at a 22.5, almost 23-year high in Fed funds. The good news for the Fed is its measures of inflation are declining, and they're declining quite quickly. So the hope for the Fed is that if inflation continues to fall, we will probably go back to that negative correlation environment, which will be potentially very nice for the equity market. When you look at inflation too, you could also argue that US inflation is actually quite exaggerated. So when you look at US inflation, core inflation, about 25% of it comes from one component called owner's equivalent rent, which makes this sort of crazy assumption that homeowners rent their houses from themselves, which, by the way, they don't do, but that's what the assumption is. So in the core CPI, around 24% of the index is owner's equivalent rent, and another 8 or 9% is just sort of, actual rents. Like if you rent your apartment, for example, and you do pay a landlord rent. So what's happened in the U.S. in recent years is that um, rental costs have been soaring. They've been going up at almost 8% per year. And the reason for that is that mortgage rates in the US have gone from 2.9% to nearly 8% as a result of these higher bond yields. And so, with the higher mortgage rates, a lot of would-be buyers are now forced to be renters. But the thing about rental costs is they tend to follow the cost of buying a home, but with a lag of about 21 months. So they tend to follow the price of buying a home, but with a lag of, on average, 21 months, or about 1 year and 3/4. So it was in May last year, about 16 months ago, that the rate of increase for home prices for the buyer's market was increasing at its fastest pace. Now that's come down to completely flat. Rents are still rising at around 7.5% per year. So when you do the math, if you take 7.5% or 8% increase and you multiply it by a quarter of the index, that means that rental costs are explaining about 2% of CPI. So the most recent CPI number shows that in the US, that core inflation is running at 4.3%. If you strip out the owner's equivalent rent, the sort of insane idea that homeowners rent their houses from themselves, which as we know they don't do, core inflation in the US is actually down to 1.9%, is very, very low. And it's a big contrast with what we're seeing in the Eurozone and in the United Kingdom. So in the Eurozone, for example, inflation is just beginning to come down. It's now still at 4.5%. And by the way, these are all equivalent measures. So it's called harmonized core CPI because this is measuring US inflation the same way that it's measured in the Eurozone and the same way that it's measured in the United Kingdom, where they don't have this concept of owner's equivalent rent. So what we can see here is that US inflation first rose much faster than it did in Europe in 2021. It peaked before inflation peaked in Europe, then it started coming down before Europe. So the US is just ahead of the cycle. This is very often the case. The US was ahead of the cycle in the late 80s and early 1990s. The US was ahead of the cycle for the global financial crisis. The US led the global recovery. The Eurozone in particular followed along much, much later. And the US, I think, will also lead this cycle as well. It's certainly leading it in terms of inflation. But inflation does seem to be falling. If that is the case, we could wind up going back to the negative correlation environment between stocks and bonds, which would, I think, be welcome news to a lot of investors. And so the thing is this: if you look at the Fed funds rate at 5.375% versus a harmonized core inflation excluding owner's equivalent rent, the Fed now has interest rates way, way above inflation. Their real interest rates are now at 3.5%, which is basically where they were in 2006 and 2007 on the eve of the global financial crisis. So this leads me to my next point. What's going to happen to the US economy next? Well, what I think is going to happen to the US economy next is I think it's heading towards a major economic recession as a result of the Fed having overreacted to what was temporary inflation that was caused by a surge of government spending and supply chain disruptions that occurred during the pandemic. Now, all of that's over. The government spending surge is largely over, although it's a little higher than normal still because of some of the infrastructure spending, but it's come way down. And all the COVID-related supply chain disruptions have been over for years. That whole process ended at least 12 months ago. But supply chains largely have returned to normal. Now, I have to admit, there is a counter argument. There is a counter argument that basically says inflation could remain at more elevated levels as a result of deglobalization, as a result of the Green New Deal or the green transition that's happening around the world with all of this infrastructure investment and electric vehicles and et cetera, and as a result of increased global tension and conflict, which we've seen between Russia and Ukraine, We saw tragically again over the weekend between Hamas and Israel. And we could potentially see more of between Taiwan and China, or the US and China, or between Iran and Saudi Arabia, or any number of other potential flashpoints in the world. So there's sort of global trend towards increasing military spending. So one of the arguments is that the reason why we had this quarter century of low inflation is because of three things. The end of the Cold War allowed a huge opening of trade around the world as China and the former Soviet bloc integrated into the global economy with much lower labor costs. Secondly, it allowed us to cut our military spending very dramatically. And that lower military spending allowed people to invest more in producing consumer goods and services. And lastly, we had rapid technological advance that also helped to cap wages and increase productivity. So there is a fear that all of this is going to go into reverse, and we won't really come back to low rates of inflation. If that's the case, the equity bond correlation could remain positive or even become more positive. But there is, of course, a counter argument. So the counter argument is basically that when you actually look at what's happening to wages, they're not really growing very quickly, at least not in the US. So in the US, for example, on the eve of the pandemic, back in 2019, average hourly earnings were growing at a rate of around 3 to 3.5%. Now they're growing at a rate of 4.2%. So yes, they're growing a little bit faster, but they're not growing dramatically faster. So also, if you look at the total labor income, which is the total amount of income flowing to the US labor force, which is calculated by multiplying the average hourly earnings by the average number of hours worked by the total number of people working, that's been growing at 5.7% per year. In the entire decade before the COVID outbreak, that was growing at 4.5%. So both of these measures suggest that maybe we're going to look at inflation 1% higher in the US than we've seen in the past. So that would imply inflation rates of around 3% rather than 2%. If you look at the break-even inflation expectation on 10-year treasuries, that's around 2.5%. So the evidence suggests that maybe there's some truth to these arguments, but it's not dramatic. We're not looking at, for the moment anyway, 1970s style inflation. We're going to be looking at inflation rates of 8, 10, 14, 20%, like we saw in the US, the UK, Germany, and Japan at the end of the 70s and the beginning of the 1980s. That doesn't seem to be in the card in the short term. I'm not saying it's impossible, but I don't think it's likely for the next few years. Now, when you look at the forward curve in the US, you see something very interesting. Basically, the Federal Reserve has talked the markets into believing that it's going to keep interest rates high for a long time. It's going to keep interest rates basically where they are until May. The market even sometimes prices some small probability of anywhere from maybe 20 to 40% on a given day, which you can observe at CME's FedWatch tool, that the Fed might even hike rates one more time later this year. That's never been a majority pricing. It's always been below 50%. But longer term, the market thinks the Fed's ultimately going to start cutting rates sometime next year, and they're going to keep rates at around 4.25% or so over the very long term. Now, that's interesting to me because it suggests to me two things. First, if I'm wrong, and we'll talk about my view in a second, but I believe the economy is headed towards a recession, as I mentioned. If I am wrong and there is no recession, the Fed may not have to cut rates at all. So they may keep rates at like 5.25%, 5.5%. So if you're long SOFR futures, if you're long our brand new T-bill futures, if you're long our Fed funds futures, out, say, a year or two in the future, and I'm wrong, the economy keeps growing, you'll lose about 125 basis points. So there is risk there. On the other hand, if I'm right, as we'll discuss in a minute, we do have a recession. The last three recessions, the Fed cut by 500 basis points or more. So you'd be looking at large potential gains. If the Fed takes rates down to 2%, you'd be looking at a 225 basis point gain. If you look at if they take rates down to 1%, you'd be looking at like a 300 basis point gain. And if they put rates at 0, you'd be looking at a 400 basis point gain. So my sense is that the risks with respect to the forward curve are skewed to the downside in terms of interest rates, which means to the upside in terms of rate futures. The way in which the rate futures like SOFR or Fed funds or T-bill futures are priced is 100 minus the price for the yield. So they're 100 minus the rate on it is the price. So if I'm wrong, the prices could go very, very, or if I'm correct, the prices could go much higher. If I'm wrong, the prices go a little bit lower. So I think there's kind of a skewness in the possibilities in terms of what might happen. And this has big implications for other kinds of investments, including for gold, which is very highly correlated to what the market thinks is going to happen to investments. So the Fed fund futures, as I mentioned, currently at 5 3/8. The market thinks 1 year from now they're going to be just below 5%, and at 2 years from now they're going to be around 4 1/4 or maybe 4 1/2, something like that. Now, gold and silver are one of the great mysteries here. Gold and silver prices, as I'm sure many of you have seen over the last 3 years and 3 months, have gone nowhere. They had this huge rally that ended in July 2020. And since then, they've gone completely sideways in a rather wide range. So gold's been bottoming around 1630 and topping out at around 2080. And part of the problem is that gold and silver do not like higher interest rates. So when the Federal Reserve started raising interest rates, that was really bad for gold and silver. So on the one hand, higher inflation was probably good for them because they're supposed to be an inflation hedge. On the other hand, lower interest rates were not so good for them, or higher interest rates were not so good for them. So here we have the price of gold in blue versus the expectation for Fed funds futures in black. And so what you can see here is that gold prices also stagnated for much of the 2010s as the Federal Reserve began raising rates. And by the end of 2018, there was this expectation that the Fed was ultimately going to raise rates to 3%. And gold did not like that. Gold prices dipped down to below $1,400 per ounce. It was not something that the gold market found very amusing. But then, rather than raising rates to 3%, the Fed instead slashed them to 0. And gold prices went from around $1,200 up to $2,080 per ounce. It was a phenomenal period for gold. And the problem for gold is once inflation struck, the Fed expectations went from 0 up to around 4.5%. So now gold prices have suffered. They're now back down to around $1,900 an ounce, or a little below that, $1,870 or so. Now, the good news for gold, however, is if I'm correct and we wind up having a recession as a result of all these Fed rate hikes, gold prices could wind up doing very, very well. We could see them break above their previous record high and continue to move towards new highs in the future. Now, the gold equity correlation is basically 0. We have a very long history of this correlation going back to the 1920s. And if you look at the correlation between gold and the S&P 500, it is basically 0. There can be very brief periods in which it shows some correlation, positive or negative, but generally speaking, these are two completely uncorrelated assets, which makes them really interesting to invest in. It's not like equities versus bonds that have an unstable and often positive or sometimes very negative correlation. It's basically a fairly stable correlation around 0. The other thing that's interesting about comparing gold to the S&P is that over the long term, the price return is not that much different. If you had invested in gold in 1928, or if you had invested in stocks in 1928, you would have done better in stocks, but you still would have done very, very well in gold. And there would have been certain periods, like in the late 70s and early 80s, or also by the late 2000s, in which gold prices had actually outperformed the market. Now, when we look at the S&P, we usually look at it just straight out, the S&P versus the US dollar. But if you take the S&P and you divide it by the price of gold, essentially you have the value of US stocks in gold terms. And what you see is that 0 correlation is one thing, but you can have incredibly strong trends in their relative performance. So during the Great Depression, from 1929 to 1933, and then for about a decade after that, until the middle of World War II, around 1942, gold was a huge outperformer. The stock market did terribly. The US government devalued the US dollar versus gold. It had been at $23 per ounce. It went to $35 per ounce. So gold did well as an investment. And the government actually confiscated gold, so you weren't allowed to hold it, gold coins, but you could still own gold jewelry and other gold items. And so then from 1943 to the mid 60s, we had this period of low interest rates. The stock market soared. It did spectacularly. And gold, of course, was just fixed at $35 an ounce. But that became unsustainable as a result of the inflation of the late 1960s and 70s. And so Nixon delinked the dollar from gold. He ended the Bretton Woods Agreement. Gold prices began to soar. And with the inflation of the 1970s, the stock market had a terrible, terrible time. It dropped around 95% in gold terms. But then at the end of the 70s, the US government finally got serious about fighting inflation. Jimmy Carter appointed Paul Volcker to run the Federal Reserve. He put interest rates at 20%, which sent the economy into terrible, terrible back-to-back recessions in the early 80s. But it killed inflation. The stock market loved it. Reagan came in with huge supply-side tax cuts on corporate earnings and high earners. We had a productivity revolution as a result of that, and the stock market soared. But since the year 2000, stock market in gold terms has had two waves so far. So it had a wave down from 2011 or from 2000 to 2011. Then it's been in this counter trend rally. But if you look back at the 70s, it also had three waves. It had a wave down from 69 to 74, a counter trend rally that lasted about 2 years, and then another wave down. I suspect that what's going to happen is that we have a lot of geopolitical instability. Inflation is less stable than it used to be. We have an argument for higher inflation over the long term because of greenflation, because of deglobalization, because of rising military spending and increased geopolitical tensions. The stock market, as we've seen, is still highly, highly valued. I think equities could be a big underperformer, and I think gold could be a great performer. So I would not be surprised if over the next decade, we see this line going way, way down. So in other words, stocks underperform gold as an investment. Another thing that makes me nervous about stocks in the short term is not just the direction of interest rates, but the fact that we have inverted the yield curve. We inverted the yield curve when I mentioned as Paul Volcker put interest rates at 20% in the late 70s and early 80s. We inverted the yield curve again in 1989. It happened again in 1999 and 2000. It happened again in 2006 and early 2007. And it's happened again. It happened even again briefly before COVID. All of these yield curve inversions were followed by recessions. And now we have the biggest yield curve inversion in the US that we've seen in many decades. So you look back here at 79 and 80, those yield curve inversions were followed by horrible recessions in 1980 and 81, 82. At that time, we had a very manufacturing-based economy. The economy responded relatively quickly within about 1 year to those rate hikes. It was in a recession. During the 1980s and 1990s and 2000s, the US economy transitioned from a manufacturing economy to a more services-based economy. The yield curve still matters. When we had yield curve inversions in 88, 89, we had a recession in 90, 91. We had a yield curve inversion at the end of the 2000s, a recession in 2001. We had a yield curve inversion in 2006, 2007, followed by the global financial crisis, which the recession officially began in December 2007 and ended in November 2009. It seems to me as a result of the sort of more servicey economy that we have, that the economy still follows the yield curve, but it follows with a delay of about 2 years now instead of 1 year. And so I think we're headed for a recession, but I think that recession probably won't begin until, I would guess, sometime from the second quarter of 2024 to the first quarter of 2025. And so remember that the last two big recessions in the US, 2001 and 2008, coincided with 50% and 60% declines in the S&P. And so if that were to happen, it could create another huge flight to quality into bonds. It could create a big dip in inflation, at least in the short term. It may come back later as a result of the longer term factors that we mentioned. But it could be a very, very bearish time for equities. And it could be a huge flight to quality into bonds. And it could cause the Fed to slash interest rates by potentially hundreds of basis points, far further than the forward curve currently projects, which would be a dream come true for gold in particular, and to a lesser extent for silver. So when you look at what's happened during the Fed's various rate hike cycles, two of them over the last 40 years, the one that ended in 1984 and the one that ended in 1995, resulted in soft landings. Those were also, I should point out, smaller rate hike cycles. The Fed only hiked by around 300 basis points in each of those two cases, and neither one resulted in a yield curve inversion. In both cases, the 3-month, 30-year yield curve came to flat or flatten slightly before bouncing back. However, the larger rate hikes, especially the one that ended in 89 and the one that ended in 2006, closer to 400 basis points, did invert the yield curve. And in both of those cases, we began a recession 17 months after the Fed's last rate hike. This time around, the Fed has done 525 basis points of rate hikes so far, so the biggest rate tightening since 1981. And if you add 17 months to the Fed's possible last hike, which was in July, I say possibly because maybe they'll go one more time. That brings you to January 2025. I think it's likely that we're looking at a downturn sometime, maybe in the second half of 2024, maybe even as early as the second quarter of 2024, or probably by early 2025. And it's not just the US, of course, that's raised rates, it's all of the central banks except for Japan and China. We've seen gigantic rate hikes in Latin America, Canada, Australia, and all throughout Western Europe, as well as South Africa, India, Korea, Australia, and New Zealand. So it's a global tightening, a global shrinkage of balance sheets. And this, I think, is potentially very, very bearish for the stock market and very bearish for risky investments in general. Now, gold and silver also, I should mention, do have a correlation with the dollar index. That's a very negative correlation. They don't like a stronger US dollar. The US dollar became a strong currency because the US has been a leader in this economic cycle. The US recovery was stronger and faster, inflation started faster, and the Fed raised rates faster than was the case in Europe. So that supported the dollar. That could go in reverse. The US is likely to go into a recession before Europe for the exact same reason. The European banks have been slower to raise rates. And if that's the case, the US dollar could begin to weaken, which would also be great for gold and silver. Now, when it comes to other products, like agricultural goods don't have a very strong correlation to the US dollar index. They did briefly in 2008 when we had a recession. The dollar soared during the global financial crisis and a big flight to quality, and commodity prices crashed. So there was a sort of temporary negative correlation. But sort of generally speaking, the correlation between energy goods and US dollar is not very strong. Where they do have a strong correlation with is between one another. So energy and ags have a very, very strong correlation. This is because agricultural goods tend to be used for energy through ethanol from corn or wheat or sugar, or as a result of biodiesel. And so if you look at the agricultural goods market, it's one of the most curious relationships. So it's a relationship between vegetable oils and crude oil, which seem to be leading indicators. So if you look, for example, soybean oil prices, which are in blue, basically stagnated in 2005, 6, and 7, even as crude oil prices rose. So what happened? Well, crude oil prices tanked and they went down to the level of soybean oil prices. What happened next was soybean oil prices started soaring in 2007 and early 2008, and they peaked out in January 2008. What happened? Crude oil prices followed soybean oil prices. They peaked out 6 months later in July 2008. Then soybean oil prices crashed during the global financial crisis. They hit bottom 2 months before crude oil did. Soybean oil there in blue hit bottom in December 2008, crude oil in February 2009. Then you can see a lot of the little peaks and valleys in soybean oil over the next couple of years happened before crude oil. Soybean oil prices again peaked out and did that last rally in 2011 ahead of crude oil. Then they began sliding. It fell for many years. That anticipated the huge crash in crude oil prices that happened at the end of 2014 and early 2015. Soybean oil prices hit bottom before crude in 2015. Crude oil hit bottom 6 months later in early 2016. And again in 2016, look, the little peaks in soybean oil are happening before crude oil. And then more recently, soybean oil prices went nowhere in 2018. Crude oil was on this big rally because Saudi had cut production. What happened? Crude oil prices crashed again down to the level of soybean oil. Soybean oil hit bottom in early 2020 before crude oil did by about 2 months. It peaked last year, 2 months ahead of crude oil. Then most recently, it did this big rally in May and June. Crude oil followed and peaked just last month. Soybean oil prices have been crashing now for months. Crude oil just plunged about 2 weeks ago. It did get a little bounce from Israel and Hamas's war, but I think the oil market has now concluded that neither Israel nor the Gaza Strip are oil producers. Israel is not likely to expand the conflict to include a big oil producer like Iran, as they already have their hands full closer to home. And so the consequences for oil from this conflict seem to be pretty minimal, at least in the short term. But what is interesting in terms of correlation is the correlation between commodity prices and China. So in China, there's a measure I love called the Li Ka-Cheng Index. It measures three things: rail freight volume, electrical consumption, and bank loans. So when you look at this chart here, you see the Li Ka-Cheng Index over there on the left in blue, in a dotted blue line. It peaked in 2007. Soybean oil prices peaked in 2008. Li Ka-Cheng peaked in 2010. Soybean oil prices peaked in 2011. Li Ka-Cheng peaked again at around 2017. Soybean oil prices were supported for a while. Li Ka-Cheng peaked in 2021. Soybean oil prices peaked in 2022. Same pattern exists for WTI. It follows the Li Ka-Cheng's peaks with a delay of about 1 year. Same thing is also true for the global copper market. Also follows the Li Ka-Cheng Index with a delay of about 1 year. China's economy recently has been doing very, very badly. I spent 18 days in China in September. Very weak consumer confidence and business confidence. People really are bargain hunting. They're not spending money. And the real estate market there is just in free fall collapse. So I think there's every reason to think that China is going to do quite badly and that resource prices are going to be in trouble. Also certain things like copper has a very positive correlation to the S&P. The S&P is also not doing particularly well right now. And the stock market's highly valued. And if we have a downturn because of all the Fed's rate hikes and balance sheet shrinkage in the S&P, probably not great news for industrial metals. So I've been speaking for a while. I said to speak about 45 to 50 minutes. I think I'm right at my limit here. So let's open it up for questions. I always have more slides. They'll share the slide deck later on. There'll be a ton more slides for you to look through, but we'll kind of stop here and pause for questions. Let's see, are there any questions?
Yeah, so please feel free, anyone, to pop the questions into the chat. I understand that the Q&A function isn't there, but please feel free to join in the chat. One of the things that I'd like to kind of ask you about, Erik, is the level of household debt in America. It's something which kind of last week was flagged as being a potential problem. Then something earlier this week came out and says, well, actually the American savings rate is actually pretty strong. Where do you think this American household debt could impact if as being a harbinger of doom this recession does come about?
Yeah, so the U.S. debt levels are pretty interesting. They have come. So the Bank for International Settlements in Switzerland publishes very extensive numbers on this question. So when US household debt got to its worst point in 2008, it was around 96% of GDP. Now it's down to around 77%. So the US households did deleverage over the last decade, decade and a half. Same thing is true for US corporate debt. However, as a result of that deleveraging, or to enable that deleveraging, there's been a massive leveraging up of the public sector. So government debt in the US has gone from 60% to 100% of GDP. And so as all these T-bills have rolled into maturity, the federal government's gone from, essentially financing this for free to, financing it now at much, much higher rates. This is not to say that consumer debt in the US is not a problem. There'll be no consequences. Student loans, some of them are in floating rates, as are going much higher. Credit card loans are going much higher. And of course, mortgage rates, mostly which are fixed rates, have also gone much higher. I am more worried about other countries. Canada, Australia, Sweden, Norway, and France have very, very high levels of household debt. France's debt levels are just off the charts in terms of corporate debt, household debt, and government debt. I think we're looking at a major financial crisis in France. Also, a lot of these European countries, like where I live in the UK, most people are on floating rate mortgages. Some people will tell you they're on what they call a fixed term mortgage. A fixed term mortgage in the US is fixed for 2 to 5 years, which means it's not fixed. There's no such thing as a fixed rate mortgage in the US. Same in the UK. The same thing is true in Spain and many other European countries. Also in Australia, same thing is true. Australia has ridiculous levels of household debt, most of which is tied to mortgages, and mortgage payments there are soaring. So I don't think the US consumer sector is the biggest risk here. I think there are consumer sectors that are big risk elsewhere in the world. But what I think is a huge risk in the US is commercial property. Commercial property was financed at zero rates, and now suddenly has very high vacancy rates. So I think we're going to be looking at very, very high risk in the commercial property market. And there's a huge amount of regional bank exposure to that in the US. So I think we're looking at a commercial property crisis in the US, not residential. And I think it's going to be more of a small bank crisis than a big bank crisis. And it's going to be more the corporate sector around commercial real estate rather than the household sector as the primary locus of the problem. Oh, I can't hear you. Are you on mute?
Yeah, sorry. I think that's a great point about the commercial real estate there. We've got a couple of questions that have come in. First one is, I don't know if you can see, how does the inversion of the yield curve in the US compare to global yield curve movements? And what can we learn from an international perspective on this?
Yeah, so I did a study a few years ago that compared yield curve shapes to subsequent economic growth across 24 different currency areas. So basically 23 countries plus the Eurozone. And found that globally, it's a phenomenal leading indicator. It works really well in Latin America, Australia, New Zealand, Canada. Works a little less well. It doesn't work so well in Japan because of all the manipulation with the yield curve that's been going on there for decades. It works well in China. It works well in in most of Europe. The yield curves around the world are not as inverted as they are in the US, but many of them are inverted. They are pointing to slowdowns globally. We're pointing to a global slowdown with the exceptions being China and Japan, but China has other problems related to its real estate sector. And Japan just hasn't begun to raise rates at all, and are decontrolling their yield curve. So their yield curve may finally start to become meaningful. But generally speaking, I think we're looking at a global economic slowdown, and I think that the real leading indicator is actually going to be Latin America, because they raised rates faster than anyone else. They inverted their yield curves before anyone else. So I think it would be really interesting, even if you don't invest there, just to look at what's happening in Mexico, Chile, Colombia, and Brazil.
Okay, that's very interesting. Something to look out for, that LATAM. I think we're just drawing to a close now. I think that Nick would like to say a few words. He's APM's SEO. and has the best shirt out of the three of us. So I'll let just thank you again, Erik, for sharing with us today, and I look forward to the upcoming webinars as well.
Yeah, so once again, yeah, big thank you very much to Erik and the CME Group. Thank you everybody for joining us. Look, we're back again on the 26th of October. Erik won't be with us, but David Gibbs from the CME Group Chicago office will be joining us. And we're going to be looking at the fundamentals of the exchange process and delving a little bit deeper into the on-exchange products, how it works, how the CCPs relate into it all. So hopefully you can all join us then in 2 weeks' time. And thank you very much once again, Erik, CME Group, Mark, and all our guests who have joined us today. Thank you very much.
Thank you.